Welcome to Thoughts on the Market. I'm Graham Secker, head of Morgan Stanley's European and UK equity strategy team. Along with my colleagues, bringing you a variety of perspectives, I'll be talking about the pace of COVID recovery in Europe and the effects on equity markets. It's Tuesday, April the 27th at 3 p.m. in London. If you're a regular listener to the podcast, you may have heard my colleagues Mike Wilson and Andrew Sheets mention what we believe is an ongoing shift from an early cycle to a mid-cycle economy, particularly in the US. However, in Europe, elevated numbers of COVID cases, new economic lockdowns, and a slow pace of vaccination likely delay this shift. In fact, negative headlines around the pace of recovery have helped feed a perception that equity investors should avoid European equities. But if you take a closer look, you'll see the reality is a bit different. The truth is, European equities have actually performed as well as US stocks this year and have actually outperformed EM and Japanese stocks quite significantly. Is this a fluke? We think not, and we see 4 reasons why European equities could continue to outperform global peers. First, despite the negative headlines, the economic data across Europe has come in considerably better than expected. This is especially true in the manufacturing sector, which benefits from the strong global recovery. That said, we are also seeing the more domestic services sector perform better than feared despite the imposition of new COVID-related lockdowns. Looking forward, one consequence of the initial delay in Europe's recovery is that there is further room for improvement in some of the key economic indicators over the summer months, in contrast to places such as the US, where arguably much of the good news is now behind us. This analogy potentially extends into next year as well, with Europe set to be the only major region of the global economy where GDP growth should be higher in 2022 than 2021. Second, the European stock market is very global in nature, with European companies also benefiting from the strong growth all around the world. So far this year, consensus earnings forecasts for 2021 have risen by over 5%, and just last week we saw the second best week for earnings upgrades since the end of the global financial crisis in 2009. While the pace of upgrades will likely slow from here, we do see European earnings rebounding by 50% or so through this year and next, which should equate to a bigger bounce back than seen in other regions. Third, Europe's so-called unloved characteristics mean that the region looks considerably cheaper than global peers and investor positioning is much more muted. While global equity markets saw near record inflows in recent months, European flows have been close to zero. Although we think investors have legitimate concerns regarding a high degree of optimism or froth in some markets, this isn't the case in Europe at all. Hence, the region may prove more defensive than normal if we do see any turbulence or volatility elsewhere. Finally, the European Recovery Fund should get the green light soon, which will lead to joint sovereignty euro area government bonds being issued through the second half of this year, with the proceeds used to fund significant fiscal expansion over the next few years. These monies should both boost the underlying economic growth, especially in the periphery, and further reduce political risk premium. If this, in turn, piques investor interest back towards the region, then this could be a powerful catalyst for further outperformance ahead, since global flows are often a key marginal driver of European equity performance. For investors, we see opportunity in stocks with a value tilt, such as financials and commodities. And we're also positive on Italy, where we are excited about the new government under Mario Draghi. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.